is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. China's export engine runs out of steam in May, adding to evidence that global demand is weakening. European stocks are lower. The SEC ramps up its crypto battle, taking aim at Coinbase. A day after suing Binance, while Coinbase chief executive Brian Armstrong says he's proud to represent the industry in court. And we're live at the IEA's Global Summit in Versailles with Executive Director Fatih Birol. Plus, we go to Berlin for the Super Return Conference, the co-president of General Atlantic. Now, first thing is first, so let's check on the markets. European shares edging lower as bigger than expected. Drop in Chinese exports really stoking further concerns about the strength of global demand. Now, we have Bloomberg Economics with a new projection now expecting the Chinese policymakers to support the economy. They're also talking about a possible rate cut in the coming month. A rotation into financial shares on Tuesday, really also suggesting in the U.S. that the breadth of the S&P's recent rally might extend beyond technology pretty soon. So back to our top story, in Chinese exports fell for the first time in 3 months. In May, the weaker data adds to risks that the world's second largest economy, well, is going to consume less commodities and everything else. Joining us now is Karen Ward, JP Morgan Asset Management's Chief Market Strategist for EMEA. Karen, thank you so much for joining us. I have a million questions on inflation, of course, deglobalization, Sunak in Washington. But China, what do you do with this China data? So you could either take it as a positive because it kind of forces policymakers to do more, or it puts a dampener on global demand.
Yeah, absolutely. I mean, in the spirit of investors always wanting Goldilocks, the perfect, not too hot, not too cold, I think the fear was that China was going to come out of its COVID restrictions and actually add too much heat to the global economy. Now, clearly that's not happening, but maybe we're now edging to the porridge being a little bit too cold. The questions, I think, are how do they stimulate now? Because, of course, traditionally, the stimulus has been very focused on the property market, on infrastructure, and that looks like a route they wouldn't want to take again, given some of the concerns still in those segments. So I think for us as investors, thinking about what routes might they take now, I think it would very much be focused on the consumer, making sure that the consumer is their driving engine, which has been a path they've been on for some time. So I suspect we'll see stimulus. It will be very different to the past.
I think Bloomberg Economics is now expecting a rate cut. I mean, that'd be a bit of a bulldozer move. What does that mean for the rest of the world?
Yeah, absolutely. I mean, again, I think we're not going to see the scale, the magnitude of the stimulus that's going to take China back into the too hot, having huge implications. It will be providing a floor, making sure that that recovery is gathering steam. They are coming out in a different situation to us post the West in that they actually, because their stimulus wasn't big in the pandemic, they have some unemployment issues. They don't have that scale of pent-up savings that we did. So I think it will be more about making sure that things are just right rather than injecting vast amounts of stimulus.
Karen, I know also you argue basically in some of your top market insights with the team that the central bank put may have been replaced with the fiscal policy put. How do you play that?
Yeah, absolutely. I mean, we've just released a big report. Just now the dust has settled on the post-COVID world. What are we learning? So we're looking at all the changes in the supply side and also on the demand side. And one of the key points is that fiscal policy, which was really dormant post the financial crisis. We came out of the financial crisis with governments very worried about the level of debt. And whilst the central banks had their foot on the accelerator, fiscal policy was really on the brake. And in Europe, hard on the brake. So that's just changed. I mean, governments essentially have got a taste for spending. They have a new mindset about the role they should play in the economy. They've got stuff to do. There's energy transition, there's defense. So I think for us as investors, it's really noting that they have their foot on the accelerator now. So that has implications for the central banks. So maybe we can sustain higher interest rates because they aren't compensating for that drag from fiscal policy. And also just that if we do encounter periods of volatility, we're probably once again going to see governments being the primary policy tool to provide that support. So I think there are interest rate implications, and also as they're intervening in the economy, directing activity, we as investors need to think about where are they pushing, because we want to be ahead of that.
But Karen, overall, I feel like the market is a little bit schizophrenic, right? It's like a week it's very positive, the other week, and I'm not quite sure how it stabilizes. So if it needs an impetus, or at the moment they're grappling at so many news stories, there are so many shocks or non-shocks across the world.
Yeah, absolutely, and I think you're right. And again, probably coming back to my Goldilocks and porridge analogy, as we go back to October, and the fear in the market was very much, gosh, we're in the 1970s. We're going to need a deep recession to get rid of inflation. Then that narrative swung a little bit too much, I would argue, early in the year, back towards the Goldilocks. Oh, it turns out inflation's going to disappear all of its own accord. We don't even need that recession anymore. The central banks can therefore focus on growth. They can cut interest rates, support the economy and earnings. And both the bond market and the equity market, I felt, had just got a little carried away. It was a little too good to be true. I think we're now just seeing a reassessment of quite how resilient growth is going to be, but also the key indicator for us is still going to be inflation. If those core numbers are sticky, then the central banks are going to be a little bit more hamstrung about quite how much they can focus on growth.
I mean, regionally, do you still focus on the U.S. as more stability, or not necessarily?
Coming back to the fiscal story, I mean, I do think that the change in Europe post-pandemic, post-Russia, is really significant. And therefore, I think, certainly relative to valuations, I think we're more optimistic about Europe as an asset class than we were, for the prior decade. And I also think one of the things I'm a little nervous about is that the rates market got a little too carried away about the central banks being able to quickly, preemptively cut rates. And therefore, as we see those rates markets, which clearly they're already taking out some of those cuts, I think that story will continue. That, to me, puts some of those growth, those mega cap tech valuations a little at risk. And that, again, speaks to perhaps less weight on the US and a little bit more diversification elsewhere.
Karen, you also understand, of course, the UK market more than most. So Rishi Sunak for 2 days in Washington. What does he need out of the US that the US would give them that would be beneficial for this economy and for UK markets?
Well, ultimately, the post-Brexit, US-UK relationship, which was always, the hope would be that would be our new focus, really. And that's been slow in forthcoming, so any ground that can be made, I think for the economy, that's a pretty significant, even some token gestures towards where we're going on that trading relationship, I think would be majorly beneficial.
Karen, thank you so much, as always, for joining us. Karen Ward, their Chief Market Strategist, EMEA at JP Morgan Asset Management. We're just getting a little bit of breaking news out of China. So China, this is the end of May foreign exchange reserves. So it is a little bit backward looking. It's definitely what we saw, until the end of May. So it doesn't really take into account some of the wobbles that we saw in the last couple of days. But reserves are at $3.1 trillion. Pretty much as expected, actually. We were expecting 3.18. We got 3.17. But who's splitting hairs? Pretty much as expected, those foreign exchange reserves. I think we'll get a breakdown of exactly what that means and what they've been buying and selling. That would be interesting to see whether there's an anti-dollar play. Now, coming up, we're joined by James Reid, the chairman of the Chief Executive, one of the UK's largest employment platforms, to discuss the state of England's job market. It's not great news for graduates. We'll dig a little deeper into that. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, graduates are preparing to leave Britain's universities, and they're facing the toughest job markets in years. Now, there are few spots available, and wages for those posts are not keeping up with the jump in the cost of living. Bloomberg is producing a monthly report on the state of the jobs market in England using data from Reid Recruitment. So we're delighted today to be joined by James Reid, the Chairman and Chief Executive Officer of Reid Recruitment. James, thank you so much, first of all, for the partnership, because we get some great stories looking at your very detailed analysis that shows us who's looking for jobs, how much they get paid, and also in what parts of the UK. What do you find most surprising about what's happening to jobs that graduates need right now?
Well, it is surprising given that there's such a shortage of skills and such a shortage of workers that graduate jobs have actually reduced. And if you look at the data, which your colleagues have sort of forensically analysed, I mean, this goes back to 2018. So the graduate job has been in decline for 5 years now. And it seems like it's going out of fashion in some sense. So the people who are perhaps expecting or looking for a role where you get a training scheme and 3 years and you're classified as a graduate trainee, those are becoming more and more scarce. And I think that surprised a lot of people. And I think it's troubling some people.
I mean, it's troubling, actually, because if you're a young graduate, I mean, this is a workforce of tomorrow, but is it because COVID has changed graduates, and so they're less used to the workplace, and so chief executives think it's more of a burden? Or is it just because it's more difficult for chief executives or companies to train them?
I think there are a number of things happening. The graduates themselves have obviously been affected by the pandemic. They've missed out on opportunities to get work experience, to do internships, to get exposure to the workplace before they graduate. And now, of course, with remote working, it's harder for companies necessarily to onboard and train people if a large part of the workforce is simply working out of their homes. And so I think companies have that in mind, and they're perhaps looking for people who've got a bit more experience, who can hit the ground running. But that is a short-term approach. Because in the long run, bringing people on in the business is a good strategy.
Yeah, and again, we have a lot of vacancies, right? I think that there's about 1 million vacancies or something of the sort out there in the UK economy. So who does that get filled by?
That's right. Well, I think a lot of graduates, if I was advising graduates, I'd say go for entry-level positions. Don't just look for graduate positions, because there are a lot of opportunities that are open to people at the moment. And some of them very well paid, and some of them in sectors that would have historically recruited graduates. Another observation is a lot of employers are very, very focused on inclusion and belonging there, EDI, equity, diversity and inclusion initiatives. And that has meant they've downplayed graduate schemes because they've been seen as somewhat exclusive and perhaps favouring certain groups. And they want to include everyone, so they're just putting everything through entry-level jobs. And in many ways, that's welcome.
Okay, so maybe some of the graduate jobs are moving into entry level. Does it make a difference if you're looking for a job as a graduate in London versus Manchester or Birmingham?
Well, one of the interesting sort of nuggets of information that come out of the data is London is not such a magnet for these jobs as it used to be. It used to be almost 40% of graduate jobs are concentrated in London. It's now closer to 30%. So that's a significant change. And we're seeing more graduate jobs appearing in places like Reading, Birmingham, Manchester. So it's more spread. And I think the way people are working now enables people to live in different parts of the country and perhaps come into London occasionally rather than every day. Because London's an expensive place for young people to live, and many are put off by that.
So I was going to say, why the change? Is it also because of the cost of living crisis, so that employers also have to pay their graduates more?
Yeah, I think it's driven by employers and graduates, really. People are looking at their options and thinking, well, if I can employ these trainees in another part of the country, that's better for my business. And also from the graduate point of view, if I don't have to pay large sums of money to commute or to find a place to rent, that's also helpful, because a very significant finding is that the wages have been squeezed. The real wages for graduate jobs have been squeezed, and they're lower than they were before. So there's a lot of pressure on young people coming into the workforce.
But James, so it's lower than before because that money, at the same time, we're seeing an increase, right, in salaries for I guess, older workers.
Yeah, I mean, many sectors are seeing increases. What we have observed, which is really interesting, is in-person premiums emerge. So people who have to attend the workplace 5 days a week, those jobs are commanding increases of north of 10%. So an in-person premium is being paid by employers for people to attend, which is interesting. But the graduate jobs overall, they haven't seen the same level of increase. And some of the sectors that attract graduates, like my own recruitment, haven't got as many jobs as they did a year ago when there was this jobs boom going on.
So I was going to ask, actually, in terms of industries or sectors, which ones are the ones where they're looking for graduates?
Well, the fastest growing sectors are education and banking, interestingly. That's where we've seen the fastest growth in jobs. But the sectors like sales and recruitment have also recruited a lot of graduates traditionally. And I think graduates like those roles because they can learn a lot. I think it's good for young people to do sales at some point, because all business involves sales. They can learn a lot. And actually, because there's a commission structure in many of those jobs, they can also earn a lot. So they're good jobs for entry level.
James, if you're a graduate and actually you have a higher percentage, if you have a higher chance of getting employed in Reading, does it mean that the levelling up agenda of the government is working?
Well, that's a big question. I don't know whether it's working, but there are some signs that it's happening, whether it's the government driving it or the economy or the labour market. There are signs that places like Reading, Bristol, Swindon have got more of these types of jobs. London has fewer. So I think if the economy is more evenly spread, that's a good thing. But I would say there's quite a way to go.
But is it in small numbers, or are you seeing a really significant move of some of these jobs elsewhere, away from London?
Well, we've seen Manchester. Manchester emerge as a very important centre and a very dynamic economy. An earlier jobs report that we did with Bloomberg showed that that was the fastest growing place for new jobs. So we are seeing that, but then you go down the road to Birkenhead and it's still depressed and earnings are perhaps 30% lower for people working there. So it's a pretty mixed picture.
All right, James, thank you so much. James Reed, the Chairman and Chief Executive Officer of Reed Recruitment. And then we'll also have an event a little bit later today with more on this index. Coming up, we'll bring you the latest on the massive dam breach in Ukraine as towns and villages in the region actually face an environmental catastrophe. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News, and we start with the UK Prime Minister Rishi Sunak seeking closer economic ties with the US during his first visit to the White House since becoming leader. Now, the two-day trip, Sunak's most extensive interaction with President Biden, will see him meet congressional leaders and company executives. The two leaders are also due to discuss Russia's war in Ukraine, Chinese aggression, and the regulation of artificial intelligence. U.S. Secretary of State Antony Blinken is said to be planning a visit to China in the coming weeks for talks with top officials, possibly including President Xi Jinping. Well, Blinken had planned to visit Beijing in February, but scrapped the trip after Washington identified what it said was a Chinese spy balloon crossing the U.S. The Confederation of British Industry has won the support of 93% of members who voted at an extraordinary meeting to decide its future. The CBI, the UK's biggest business group, asked members to support a reform programme aimed at winning back trust following multiple allegations of sexual assault among staff. Well, loss of the vote could have led to the organization's imminent collapse. And that's your Bloomberg First Word News. So President Biden has vowed to continue assistance to Ukraine after an explosion at a major dam flooded villages and threatened supplies of drinking water and electricity. Ukraine's economy minister told Bloomberg that the attack should be considered an ecological weapon of mass destruction. Well, she spoke to us in an exclusive interview.
What happened today, without any doubt, it might called and should be called the biggest man-made disaster. And the Russia, they proven once again the whole world that they act like a terroristic state, and I think they used this disaster, and it seems to be like an ecological weapon of mass destruction.
Well, the Kremlin has denied responsibility for the attack. Joining us now is our Bloomberg senior reporter for international affairs, Mark Champion. So, Mark, thank you for joining us. This is devastating. It's an important story. Do we actually know who's behind the attack?
Not yet. There's an awful lot we still don't know. It is interesting that the US and the UK, very strong supporters of Ukraine, have still not pointed the finger officially at Russia. They're still looking at it. Their intelligence agencies are still looking at it. It may take us a little while. But short answer is no.
So, Mark, evacuations are underway. What do we know about, of course, the flood's impact on people and agriculture in the region?
Well, the impact will be large. A lot of people had been evacuated because the banks of the river Dnipro had become the front line. So there was a lot of trading of artillery and so on. So, there wasn't the same level of population as before the war. Nevertheless, it is devastating. A lot of people, civilians, did live there. They are being evacuated. We know on the Ukrainian side. We assume on the Russian side we know a lot less. Most of the worst of the flooding is on the Russian-occupied side, the eastern bank, just because of the geology there. The geography is it's lower. In terms of the ecology, we know there's a lot of oil and other pollutants that have floated down the river together with all this water. We also know that the reservoir provided water for irrigation in what is a major area for agriculture and grain production in particular in Ukraine, both sides of the river. And that irrigation will now be lost temporarily, if not permanently.
Mark, what does it mean for the Ukrainian counteroffensive?
That is a really good question, and the general consensus seems to be that if the Ukrainians were planning to try and make an assault across the Dnipro, which remember is as much as a mile wide at points, very difficult feat, then that's now become impossible, basically, for now. However, that's temporary. This essentially what the flood will do is, it's burst the banks, it's made, any kind of crossing impossible, but then it will subside. The reservoir will empty. When it does, the river will return to its pre-Soviet course. And the net effect of that will be in some places on the river, it will actually be lower than it was before.
Mark, thank you so much, as always, of course, for your great reporting, great analysis. Mark Champion, their reporter for international affairs. Coming up, we're back in Versailles with the IEA Executive Director, Fatih Birol, who will give us his insights on the future of energy. This is Bloomberg. China's exports engine run out of steam in May, adding to evidence that global demand is weakening. European stocks are lower. The SEC ramps up its crypto battle, taking aim at Coinbase the day after suing Binance US. Coinbase Chief Executive Brian Armstrong says he's proud to represent the industry in court. And we're live at the IEA's Global Summit in Versailles with the Executive Director, Fatih Birol. Plus, we go to Berlin for the Super Return Conference for an exclusive conversation with the co-president of General Atlantic. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the U.S. Securities and Exchange Commission is suing Coinbase. It has accused the crypto exchange of breaking rules, including letting users trade tokens that were actually unregistered securities. The SEC chair, Gary Gensler, spoke to Bloomberg's David Weston about the action against Coinbase and Binance.
This is actually a straightforward securities case, but it's in the context of crypto. And let me just say, crypto tokens, the investing public needs that same disclosure, a full, fair, and truthful disclosure, we say. And in the crypto space, it's largely built on a business model that's non-compliant with the securities laws. People are commingling all of the customer funds. It would be as if the New York Stock Exchange is also operating a hedge fund and trading against their customers, or add to it that they don't have proper controls to avoid manipulative trading on the platform by their sister. So here, Binance had a sister organization controlled by Mr. Zhao called Sigma Chain. So absolutely, it's straightforward. Protect the public through the securities law, build confidence and trust, but it's in the context of crypto.
You have said elsewhere that there are certain custody rules here that registered financial advisors have to pay attention to when it's something like Binance. Are you looking at some of those financial advisors for possible violations?
Look, I'm not going to get into any one investigation or case that we haven't yet brought, but I would say this to all of those investment advisors out there that may be interested in trading in crypto. Your client funds, under an existing 2009 rule, have to be proper qualified custodians, and that's not what you have on Binance. Make no mistake. In fact, as we alleged, your funds in custody at Binance, you don't even know really who's where it is. You know that Mr. Zhao ultimately is controlling it, but it may have actually moved it to a sister organization. There's another one that we allege, Merit Peak, that billions of dollars of funds were moving to.
SEC Chair Gary Gensler there speaking to Bloomberg's David Weston. Now, the PGA Tour and the Saudi-backed LIV Golf have agreed to a shock merger. It ends a 2-year battle that saw the upstart splash millions of dollars to lure some of the biggest players away from the traditional PGA events.
Obviously, it's been a very dynamic and complex couple of years. And for players, I'm not surprised that, this is an awful lot to ask them to digest. And this is a significant change for us, in the direction that we were going down. But as I'm trying to explain, and I will continue to explain as we go forward, this ultimately is a decision that I think is in the best interest of all of the members of the PGA Tour.
Let's get more now with our Saudi Bureau Chief, Matthew Martin, in Riyadh. So, Matthew, after competing so aggressively, why are LIV and the PGA suddenly changing course so dramatically?
Yes, look, as you say, this is a really dramatic change, of course. The war of words between the PGA and LIV had been going on quite vociferously in the press and in the courts. And they have managed to keep this deal cooked up very quietly amongst a small group of advisors and the main principals in this, Yasser Al-Rumayyan, the head of the Saudi Sovereign Wealth Fund, and Jay Monahan from the PGA. But they're doing this now to bring an end to the court battles that have been going on, the fight over players. This has all been getting quite ugly in the press and in the courtrooms. It was threatening to potentially drag on and on through legal proceedings, maybe even involving a subpoena of the boss of the Saudi Sovereign Wealth Fund as well. It was dragging in all sorts of different corners of life, from critics of Saudi Arabia, victims of the 9/11 terrorism attacks in the US. So it was all getting quite ugly and quite protracted, and so this enables them to draw a line underneath all of this and now concentrate on just playing golf.
So, Matthew, who's in control actually of golf now? PGA or the Saudis, and how much will they both be investing in the future?
Well, this is going to be an interesting question to watch as this develops. So initially, under the terms of this agreement, the new entity which is formed, which still doesn't have a name, the main economic voting rights are going to be held by the PGA at the moment. But we do know that the head of the Saudi Sovereign Wealth Fund, Yasser Al-Rumayyan, is going to be the chairman of this new entity. The PIF is going to be investing, they've said, billions into developing golf and to developing new tournaments and new competitions around the world. And they've also said that they have essentially a sort of first right of refusal over investments in new projects. So I think we will see over time that that balance of power may well shift. And with Yasser as chairman, it looks like the Saudis are very much at the top of this new entity.
Matthew, as always, thank you so much for joining us on this important, of course, golf story that feels more like foreign policy in certain cases. Now let's get straight to your Bloomberg Business Flash. And UBS says there will be a grace period of more than 2 years before Switzerland imposes higher capital requirements related to its takeover of Credit Suisse. Now, an increase in capital triggered by the acquisition will be phased in from early 2026 based on an integration plan to be developed by UBS. Boeing will delay deliveries of its 787 Dreamliner after uncovering defective parts. The plane maker says it may affect about 90 already built jets and a few being assembled. Now, Boeing and U.S. regulators have decided if they need to take any action for jets currently in service. The company says it still expects to deliver about 70 to 80 Dreamliners this year. Now, former Diageo chief executive Ivan Menezes has died after a brief illness. He was 63. He had been hospitalized and was receiving treatment for medical conditions, including a stomach ulcer. Menezes joined Diageo at its creation in 1997 and transformed it into the world's biggest premium drinks company during 10 years at the top of the business. He is succeeded by Chief Executive Deborah Crew, currently the company's interim chief executive. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, this is what stocks are doing at the moment. We're seeing a bit of pressure across the board, not only in U.S. futures, but also in European stocks. So let's get that board up. And it's definitely the bigger than expected drop in Chinese exports that's really stoking fears that there are concerns coming up about the strength of global demand because of China. Now, it does seem that signs of fading momentum in the world's second largest economy are weighing on sentiment globally, damping the optimism surrounding China's reopening from pandemic restrictions earlier this year. Now, the conversation is shifting when it also comes to private markets. As big firms get even bigger, a fragile economic backdrop threatens the survival of their smaller counterparts. Now, this dynamic will be a theme at Super Return's 3-day conference, which kicks off in Berlin today. Bloomberg's Danny Berger joins us from the event with an important guest. Danny, over to you.
Francine, thanks so much. I'm really excited for our next conversation. It is Gabriel Caillot. He is head of EMEA, co-president and managing director at General Atlantic. Gabe, thank you so much for joining.
Thanks for having me.
You'll have to be patient with all the sound. I mean, it just shows how buzzing this conference is. But look, it's a time of change. It's a time of uncertainty. Is this just a slowdown for the industry, slower deal flows, financing, or has the playbook shifted? Is something really changed?
Listen, I think in a lot of ways, the reset we've seen the last 24 months has been super healthy in some parts of the market and a real challenge in others. And what's unique about what we've just been through is you think of every segment of the market, it's completely shut down, right? We've seen equity capital markets shut down, the debt capital markets have shut down. And I think, one, it gives us a chance to rethink our model. So how are you making your money? How are you driving your performance? But then on the flip side, it gives us an amazing set of opportunities. And as much as we've spent the last 24 months really hunkering down, figuring out how we're going to drive performance of the portfolio, and we feel really good about that, I think what we're most excited about now is as we look forward, we think there's a set of opportunities like we've never seen in our careers.
And what are those?
I think in what we do in growth equity, because we're neither driven by capital markets liquidity or the debt markets, what we're seeing is continued trends. So the same trends that drove our business forever, so digitization and globalization, they haven't changed. Stock markets don't impact that. A potential recession doesn't even really impact that. What has changed is we're finding the same themes, same companies, but half the prices as just 12 months ago or last time we met.
So, okay, you're sitting in a good position. You're not worried about some of these financing markets because of the nature of less leverage. For those that aren't, could I say, okay, maybe rates are going to come down at some point next year. We can go back, same as normal, we'll be okay. Is that fair, or is that a little too sanguine?
Interestingly, we barely worry about rates, which I know is counterintuitive for private equity, but our portfolio is mostly unlevered. And even those companies that are levered, the investment thesis is growth. But I think it's a question of how much risk you're willing to take. And it's a hard one to think now that rates are going to stabilize quickly or go down quickly. And I'd be nervous as an investor if that was part of my investment thesis, right? Now, you see it in deal volumes across Europe. We haven't slowed down. Our business from January to now, we've committed almost $6 billion of capital globally. I think the buyout industry is really struggling because the whole thesis of their investment style, which is lower growth companies using cheaper capital, is really challenged by the market.
So what happens to them then? Will there be consolidation?
I think so. It's not, in a way, it's not surprising. Our industry is maturing, right? The industry of private equity has gone through a huge period of growth, which has been massively productive, right? I think it's a product that investors like, it's a product that entrepreneurs like. But as every industry, as it matures, you're going to see winners emerge and you're going to see people that need to be consolidated. And I think we think about this a lot, and I think the winners are going to be brands and companies and investors that have, one, a strong brand name that represents their style of investing. I think you need to have an origination that's differentiated. So are you finding better opportunities than others, right? Are you creating opportunities for value creation? And I think the last is being a solution provider to investors. And that's one of the big themes, at least I'm hearing in the conference right now, is after this huge period of boom, our investors, so our LPs, are starting to look at actually who's delivering on their promises and who isn't, who is stuck true to their investment philosophy and thesis and who isn't.
So for the consolidation piece, how does that happen? Does it happen by M&A within private equity?
Listen, no crystal ball, but I wouldn't be surprised that what's going to happen is I think those that aren't differentiated are going to really struggle in this fundraising cycle. And you can hear the tone around is it's a harder fundraising cycle than we've seen for the last decade, right? And I think undifferentiated platforms will struggle. And then you have a question is, if you stop growing, are you better off in a stronger, bigger platform? Or do you become a niche business? And I think that's going to drive a lot of M&A.
Well, part of the struggle, if you're not fundraising and rates are moving higher, the cost of capital is higher, you have to decide how to handle the companies you currently have. We saw venture capital had a liquidity issue, SVB. Yeah. Does this industry, does private equity have a liquidity issue?
I think different slices of the market will have some challenges. I think it's more acute in venture because if you look at a venture portfolio, and we do a little bit of late stage venture, most companies need capital to grow, right? It's the nature of those investments is they have to constantly fund themselves. And historically they had SVB, but they also had the equity markets. 1,000 IPOs in 21 in the US alone. That market has I think a meaningful liquidity challenge in the next 18, 24 months. I think they're hunkering down with what they have on balance sheet, but that opportunity will come. And then I think on the late stage of our industry, where people were using leverage to drive their performance, there's a real refinancing question to come, right? Is as debt matures, and it was 3% capital, and now it becomes 9 to 10% capital, what does that mean for the value of your underlying assets?
What does it mean?
I think it means it should be down, and those who are pretending like nothing's changed, I think are not being fully transparent.
So Gabe, your business is very global. You have a lot of investments in China, with TikTok, with Shan, with Ant. We heard overnight that Sequoia is breaking up. They're breaking into 3 different entities. That includes separating China from the U.S. There's a lot of geopolitical tensions. What do you think of that separating businesses as a strategy to cope with that?
Yeah, we've been in China 22 years, and it's been a wonderful market for us. It's been a very profitable one. We've seen great investment, and frankly, Sequoia has been hugely successful in the market. I think still today, when we look at the market, I think there's some changes that are happening. It used to be you just invested behind China growth and you thought your performance would come out. I think what's changing now, in our view, is we're still constructive on China, but you need to be more localized. So you need to have real people on the ground that understand the intricacies of the markets. And that means that you also need to be very sector aware of where you're deploying capital. There's certain sectors where the geopolitical risk is just too great, right? We saw it, anecdotally, we saw it with the education market getting completely shut down. But you can imagine the same is true with life sciences, the same is true with the chip industry, right? The same is true with some of the vertical software industries. So separating the business is not something we'd ever consider. We still think China offers great opportunity. And so I don't have specific insights from what Sequoia's done, but I think our investors still want China exposure, and we think there's still a great money-making opportunity there.
How are you looking at growth in China? Because the macro data, I know you're focused on the micro, but hang with me here. The macro data has been slowing down. Have you seen that reflected in the companies that you are involved with there?
Yeah, listen, it's really interesting because I think the data is pretty conflicting, and a lot of people talk about the de-risking of China or even the decoupling of China. The truth is, if you look at trade volumes, they've been stronger in Q1 with the U.S. than ever before, right? So there's some truth in the numbers, and then I think there's what the other things people are saying. Whether there's a softer landing in China, whether some of this recent information and data around exports drives growth, it could. We haven't seen an impact on our portfolio yet. Interestingly, our portfolio is really the Chinese consumer and Chinese consumption. That hasn't slowed down at all, right? And we're seeing really strong rebounds post the very tight COVID lockdowns.
All right, Gabe, that's all we have time for, but I'll give you a break. I know we have a panel together, so you don't get sick of me. We can take a little bit of a break here.
Look forward to it.
Gabe, thanks so much. Francine, that's Gabrielle Cayo, head of EMEA and co-president at General Atlantic.
Yeah, wonderful interview, as always, Danny. Great work out there. Danny Berger with Gabrielle Cayo, General Atlantic's co-president and head of EMEA, as Danny was just saying. Coming up, crypto crackdown, a second lawsuit in 2 days as the top securities regulator sues Coinbase. We'll ask what this means for the crypto world. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the IEA's 8th Global Annual Conference convenes today against a backdrop of waning demand from China, production cuts from Saudi Arabia, and an intensification of the conflict in Ukraine. Global leaders in the sector look to get back on track with energy efficiency, the theme of this year's event. Well, we're delighted to be joined by Fatih Birol, Director of the International Energy Agency. Fatih, as always, thank you so much for joining us. How far are we from reaching the net zero in 2050? How much progress have we made since last year?
Yeah. Thank you very much. In fact, when we look at today, the global energy sector, there is one trend which is very obvious, namely a new clean energy economy is emerging, and emerging faster than many people think. Just let me give you a few examples. Last year, about 90% of the new power plants built in the world were clean. Only 10% were fossil fuels. Electric cars. 2 years ago, 1 out of 25 cars sold in the world was an electric car. 1 out of 25 2 years ago. And this year, 1 out of 5 cars sold in the world is an electric car. Heat pumps going very, very strongly. And also nuclear power is making a comeback, a very strong comeback across the world. So when I look at the all energy sources, of course we will need oil and gas for a few years to come, next years to come, but we see a clean energy going very strongly, but still not fast enough to reach our ambitious climate targets in the world.
Fatih, we also had this OPEC meeting over the weekend. What is your reaction to the Saudi decision? How far will oil prices keep rising?
Yeah. Of course, it is up to OPEC members, producing countries, what kind of production policy they are going to follow. But when we look at our numbers, which is taken as the benchmark for the real players in the oil markets, it says that under normal conditions, second half of this year will be tight, already tight because of the strong demand, about 2 million barrels per day growth, which is similar to many other organizations, and supply is not going that much. So on top of that, having a production cut might exert pressures, upward pressures to the prices.
But do you have a bearish view overall on how the oil market is evolving given recession fears and demand from China?
I think if there are many uncertainties, as usual, when it comes to the oil markets, and if I have to pick up one, the most important one, it is Chinese economy. So when I say more than 2 million barrels per day of growth we expect this year in global oil demand, 60% of that growth set to come from China. If Chinese economy weakens or grows much lower than many international economic institutions believe, Chinese economy believe, of course, this can lead to a bearish sentiment. But with a normal business as usual economic growth pattern of China, we may well see also with this production cuts upward pressure on the prices.
Fatih, thank you, as always. Fatih Birol, the director of the IEA. We'll have plenty more on the markets coming up. Bloomberg Surveillance Early Edition continues in the next hour, and this is Bloomberg.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Downbeat data. China's falling exports stoke further concerns about the strength of global demand. Meanwhile, the OECD warns the world economy is set for a weak recovery this year. Citigroup CEO Jane Fraser visits Beijing this week, joining other Wall Street executives to travel to China despite growing geopolitical tensions with the US. And the SEC doubles down on its crypto crackdown, taking aim at Coinbase a day after suing Binance. Coinbase says it's willing to take this legal fight to the Supreme Court. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. There's plenty to talk about today, Kriti, from data out of China, geopolitics around China, the crypto story, of course. All that very much in the mix, not having a huge impact on markets, perhaps, where we see equities looking a little sluggish this morning.
A little bit sluggish, and I think fairly so, perhaps, as we talk about those global growth concerns laid out by the OECD, laid out by China as well. That's certainly denting a little bit of sentiment, I want to say, on both sides of the Atlantic and arguably Asia as well. Futures down 0.1%. Look, Anna, we don't see a ton of momentum in either direction in the last couple of days, especially at this time of hour. But where you are seeing a little bit more direction is in the bond market. The two-year yield really testing that 450 level, and that is crucial as we talk about just how much closer it gets to 5%. It has everything to do with bets about just how hawkish the Federal Reserve will be. Because, look, they're dealing with a very hot labor market, but also dealing with those growth concerns that are now really seeping into the United States from around the world. Nevertheless, 2 basis points higher on the front end of the curve there. So seeing a little bit of sell-off both in the stock and the bond market. As those yields move higher, though, you are seeing a little bit of a dent in the dollar as well. Slight weakness, nothing I would write home about, down about 0.1%. Again, in the face of that decelerating global growth environment, the dollar tends to be the place. So really keep an eye on the greenback there. NYMEX crude gets interesting because, again, if technical levels are driving the bond market, and they're driving commodities as well. Even if OPEC Plus did kind of put, in theory, a floor under prices, you're starting to see NYMEX crude kind of test 70 again, 71 handle for that commodity, only higher by 0.2%. So, Anna, if there's a takeaway from this markets board, I think what I would say is no conviction in the trade just yet, but perhaps souring momentum.
Yeah, we certainly see a lack of conviction today here in Europe, Kriti. This is the European expression of that. The London market entirely flat. A bit of downside risk coming through on the DAX and the CAC. Outperformance, though, coming through in Spain. And when I show you the other assets in focus today, you'll see why that is. A big focus on retail here in the European trading day, and this has very much to do with Inditex. So the retail sector is the sector that really outperforms. It's up by 2.4%, really stands out compared to others on the day. Inditex is the owner of the Zara brand, of course. That stock up by 5.9%, and it is a giant of the Spanish market. So as a result, it lifts that whole geography. It also lifts the sector. And what's really interesting here, Kriti, is we all know that there has been a lot made of the future of retail being online. Well, it's the actual bricks and mortar stores making them bigger. Apparently, that persuades people to buy more. Who knew? And that is playing out well for Inditex. We had one analyst describing the results from Inditex as stunning this morning. Here's the dollar actually on the rise against a falling Turkish lira. So weakness in the Turkish lira. Is the government in Turkey about to give up on a very expensive project plan that they had in place under the former finance team? Are they about to give up on that? And that's leading to some weakness in the currency here. And Brent crude is, as you showed with WTI, just showing a little bit of positivity, Kriti. We had seen it weighed down in the earlier part of the session by the data coming out of China, exports and imports falling. But within that, really interesting detail about imports of commodities, whether it is oil or copper, or oil or gas, or some of the other commodities that, of course, China imports. We actually saw those remain pretty robust in the most recent set of data.
Yeah, certainly a topic that's worth diving into when we talk about the global ramifications of those kind of numbers. To build on your point, Anna, Chinese exports falling more than expected in May, adding to risks in the world's second largest economy as global demand weakens, as you just laid out, Anna. Joining us now, Bloomberg Shanghai Bureau Chief Charlie Zhu. Charlie, walk us through what this actually means in terms of just how quick the deceleration in China is really taking place.
Yeah. Exports, as you know, at the beginning of this year, served as kind of a growth engine for China, thanks to the lifting of all the, 3 years of COVID restrictions, But quickly they are showing signs of losing steam, as you just mentioned. It, fell the first time in 3 months, and also, it's sharper. The drop in May was sharper than expected. So basically, we're seeing, exports to its, to China's main overseas markets, from U.S. to Japan to Southeast Asia and some European countries, are seeing, saw double-digit decline, which is a bit not a good sign for the economy, and also at the same time definitely raised the question whether China can meet its growth target for this year, which is at about 5% this year. And there are a lot of debate at the moment whether China needs to roll out a new round of stimulus. That's something we'll have to wait and see.
Yes, and thinking about that, Charlie, what are the measures that the Chinese government is considering taking to shore up the economy? For the last few days, in the early part of my trading day, all the way through yours, no doubt, the big question in China has been whether we'd see further stimulus coming through, in particular from the PBOC.
Yeah, there are a lot of speculation or expectation that China may consider cutting the reserve requirement ratio for banks just to free up more resources for lending to support the economy. And also there are a lot of gossip that China may up to cut its interest rates as soon as later this month or early next month. But it's a tough question. We don't know whether PBOC will do that now, given the rate differential. I mean, the differential between the U.S. and China Treasury yields, remains pretty big. If you you announce a big cuts, probably that could lead to capital exodus, which could risk destabilizing the whole country. There are some other options, available, such as a further round of property easing, or more targeted support measures for certain industries, from EVs to other durable goods. So anyway, this remains a focus of everybody's discussion at the moment.
Yeah, certainly a lot of factors to juggle in terms of the global ramifications. And remember, in the 08-09 recovery, China's infrastructure plan was a really big part of that story. Bloomberg's Charlie Zhu in Shanghai. We thank you, as always. JP Morgan CEO Jamie Dimon says the Biden administration is pursuing the right strategy on China as well. Dimon spoke in Washington yesterday, fresh from a trip visiting clients in China last week. Joining us now is Bloomberg's Asia government and politics reporter Rebecca Chung Wilkins. What did we learn from Jamie Dimon's visit? He has very famously said, look, we're going to be in China in the good and in the bad. What are the developments from his trip?
Absolutely. Well, Dimon very complimentary about Biden's administration's policies when it comes to China, particularly stressing that Blinken and others are rightfully talking about national security, rare earths, semiconductors, and unfair trade practices. But of course, as you say, coming on the heels of this trip, and really the remarks underscore this tension, I think, for not just Jamie Dimon, but all US banks to have to balance, to some extent, the need to have maintained exposure into China and into the Chinese market, whilst also managing this increasingly hawkish environment. And we did see, even after those sort of compliments from Dimon about Biden's approach, we did see some lawmakers still criticizing that Dimon didn't go far enough, that he's so-called whitewashing China's aggression. And it particularly comes at a time when we are seeing what the US categorizes unsafe maneuvers around certain US military vessels that are conducting freedom of navigation operations.
So we've seen Dimon, then Rebecca, in China. We've seen Musk in China. We've seen a lot of US executives in China recently. Citi's Jane Fraser, is going to be visiting China as Wall Street is seeking closer ties, we understand. So what's the drive behind her visit?
Absolutely, and not just Wall Street seeking closer ties, but Beijing too, very much rolling out the red carpet. I don't think it's a coincidence that we are seeing this flurry of activity, and in part it is to combat that skepticism that followed the message from authorities, a couple of months ago at the Boao Forum, which is sort of China's equivalent of Davos, really trying to lure foreign investment back in. In part, this is a Wall Street effort after revising their profits around China, cutting some jobs and some exposure to China too, again trying to sort of repair that relationship. And Jane Fraser, again, in those remarks, stressing that they are optimistic about the financial development in China, as well as expanding their onshore operations too. And it's really those onshore operations which are critically in focus, particularly because we're coming off the back of this crackdown crackdown on consultancies firms, which are among sort of count US banks among their clients too. So this whole question of the ease of doing business will be critical for Fraser and others to really determine on these visits.
Rebecca, thanks very much. Bloomberg's Rebecca Chung-Wilkins joining us there with the latest on that visit and a number of China themes, in fact. Now, let's talk about the crypto sector, because crypto investors are digesting the SEC's enforcement actions, and there have been plenty of them. First, against Binance on Monday, and then against Coinbase yesterday. Bloomberg's David Weston spoke with the SEC chair, Gary Gensler, about the two lawsuits.
I think the crypto industry more broadly, if it's going to have any success going forward, has to come into compliance with basic public policy about disclosure, about avoiding conflicts, about properly segregating customer funds, and guarding against fraud and manipulation.
Gary Gensler there. Emily Nicole, our crypto reporter, joins us now. Emily, very good morning to you. So tell us more about the SEC and what it alleges in this case against Coinbase and how it's responded.
So for Coinbase, it was a pretty straightforward complaint from the SEC. It's that Coinbase does several things under one house, things that in traditional finance we might see companies do under several separate units, and the SEC disputes that. It also says that several cryptocurrencies on Coinbase's platform are unregistered securities, and so therefore, with Coinbase not being a registered securities broker, it doesn't have permission to be selling those to the public.
Emily, the timing here is fascinating, because isn't 2023 supposed to be the year where we get the digital yuan, the digital euro, potentially? In that context, how deep could the crackdown on crypto get in the U.S. specifically?
Well, to be clear, things like the digital euro and the digital yuan, those are central bank digital currencies. They're quite different from cryptocurrencies like Bitcoin and Ether. Where the US is concerned right now is, how many of the crypto companies in our space are operating without real oversight from them, ways that they can, make sure that consumers are protected. And so that crackdown is really coming now in force. Because lawmakers in Washington are so tied and split over whether or not they could even pass crypto legislation this year or even next year, this is really the only route the SEC sees that it has.
Emily, thanks very much. Emily Nicole joining us there with the latest analysis on the Coinbase part of this SEC front against crypto. We'll be hearing from the Coinbase CEO, Brian Armstrong, today on Bloomberg at 1:30 p.m. Eastern Time. So interesting to get his take. He has said, of course, he's willing to take this to court. Coming up on the programme, chip makers falling after a monster surge this year. We will speak to HSBC's Frank Lee with a street-high price target on Nvidia. We'll talk AI. We'll also be speaking to Gordon Shannon of 24 Asset Management and why he sees more risks of a hard landing. We'll also get his take on the wave of issuance that's due to come from the Treasury and what that's going to do to other assets. Plus, we'll be live from the Super Return Conference in Berlin. An interview with the Ares Management CEO. That is coming up shortly on this programme. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, all the rage around the stock market has been about concentrated gains in tech. One name getting a lot of flack for that, Nvidia in particular. We know we've seen that AI kind of storm, that frenzy, really capture those shares and with it take the benchmark even higher. But we're going to evaluate just how high those share prices can go in just a minute. I want to bring to our audience a chart that I find very, very interesting. For our radio audience, stick with me here. We're looking at a price chart of Nvidia shares with the best price targets, essentially the 12-month price targets on Wall Street. And you can see they've kind of followed a similar pattern until this kind of most recent announcement on May 24th, this big AI push from Nvidia. So the shares, of course, rallied to 386. The price target, the average price target on the street, 452. But there is one name that has the street high above them all, shooting for even more upside of $600 a share, signified by this green dot right here. And joining us with that street high price target right now, Frank Lee, HSBC's head of Asia Technology Research. A pleasure to have you on the show, Frank. Let's start with the promises made by Nvidia here. Your case largely rests on their pricing power. Why does Nvidia have that pricing power, given that there's so many entrants into the AI market right now?
Great, that's a great question. I think, what's really shocked us, even, by our standard, was just the pricing power that Nvidia was able to gain this early on in the AI race. I think, what they've demonstrated was just that they can basically take nearly the majority of the industry profits, at least its early stage of AI. So I think if you think about this in perspective, when they sell a traditional gaming GPU, which is what their core business was in the past, the average selling price is somewhere about, anywhere between $1,000 to $3,000. But today, if they sell that AI GPU to be used in an AI, your average selling price is now $20,000 to $30,000. So you're talking about a huge magnitude of increase. And I think that's what really was a surprise was, how strong this bargaining power is. So I think that is what we were more bullish going into seeing this trend. But we were also quite surprised by the magnitude of its its revision that we saw for the upcoming quarter. And I think it's not over. I think this is just the beginning. We will continue to see them dominate this year. It's really a monopoly in terms of solutions. And I think what's also strong, what's also probably underappreciated is the ecosystem they're working on right now. They are doing not just the GPU chip itself, they're actually selling more systems now. And that is something that they are continuing to push more. And they've also got the software ecosystem. So it's really a very complete ecosystem.
Well, a lot of promises being made, a lot of assurances being made by Nvidia, but Frank, that requires a lot of investment. Let's talk about the infrastructure here. In a decelerating growth environment around the world where business investment is dropping significantly, does Nvidia really have the infrastructure and the investment to scale up in the way that they're saying that they're going to?
Yeah, again, it's also a very good question in the sense that I think if you look at one of the concerns that investors had is that, to your point, which is the overall macro environment is getting weaker. The hyperscalers, the data center guys, they're not raising their overall capex per se. So I think this led people to kind of think that this is going to lead to a slower ramp. But what we're seeing, though, is that the budget is being reallocated today from traditional server and data centers toward AI. And so that continues to drive the strong growth that we're seeing for Nvidia. And I think it's something that people are going to continue to prioritize over the immediate future as well.
Okay, good morning to you, Frank. What limits the pace at which AI opportunities can grow? So if we're looking at your price target, we're looking at what we've seen on Nvidia already, is there a limiting factor, a growth limiting factor that you're watching to make sure that we don't kind of bump up against that in the case of Nvidia or the broader AI space more generally?
Yeah, I think that the main thing is really just about, the beginning of ChatGPT was just kind of the taste of AI, and that really kicked off. I think the best way to describe this is just an arms race. It's an arms race between the hyperscalers right now. They're prioritizing AI. So the question is going to be, the longer term. I think beyond this initial phase is going to be the overall practical applications, right? But I think we're in the early stages of this arms race. So I think for the immediate future, this is something that none of the companies can afford to miss out. So you're seeing. All the big companies are engaging in this early stage arms race, and effectively, Nvidia is right in the center of this and selling basically to everybody in terms of the beginning of this race.
So practical applications could be a limiting factor further down, but at the moment we are in the early stages, you say, of this AI arms race, as you described, Frank. Yesterday we had interesting conversations with guests about whether this was like 1999, but instead of .com, about AI. Some suggest, no, actually it's more like 94, and there's a lot more to play for here. I don't know if you look back at historical parallels, whether they prove useful at all.
Yeah, I mean, I think historically it's always good to have a reference, but I think it's also at the same time, there's going to be different dynamics. I think with this, if you think about just 2-3 years ago, there was a lot of enthusiasm around metaverse, right? And ultimately, 6 months later, people, even today, we're not really talking too much about metaverse because the practical applications didn't really catch up and the investments didn't really come through. I think with AI, we have a different story. I think we're really at the beginning of a transformational period. We are, going to see a lot more investment, and already today we're seeing it. So, Nvidia is the best example of that, delivering on the investment and the upside. We haven't really seen that happen in with the enthusiasm that we saw with metaverse. We didn't have anybody that really benefited to the extent we're seeing today with the AI.
Yeah, definitely. Fundamental investment, both, I want to say, from the government side, but also from the corporate side, no doubt about it. But Frank, what changes your price target here? What is the biggest risk that you're seeing? And put some numbers on it. How much of damage could that risk put on the stock price?
Yeah, I think the key concern is going to be probably in an immediate term is after the initial phase of, this initial phase of AI is really about training, all right? And then there's going to be, the second phase, which is going to be more about inference when it comes to AI. And there's going to be, I think, the next stage that people are going to kind of recheck is to see if Nvidia's dominance that we're clearly seeing in the training part of this phase can continue into the inference phase. We are going to see, competitors, even some of their own customers, such as the hyperscalers and the cloud customers, thinking about designing their own chip, which is based on what they call ASIC, as an application-specific IC, to see whether or not they want to do this themselves in-house. So I think that's going to be probably the next major checkpoint. But I think we're probably, a good, at least 1 to 2 years away from that stage. So I think, in the near term, we're going to continue to see very strong momentum from Nvidia.
Okay, Frank, thanks so much for joining us. HSBC's Frank Lee joining us to talk about Nvidia and the broader opportunities around AI. Really fascinating conversation there, then, Kriti. Thinking about the practical applications, and that could end up being the limiting factor. That could put a top on the extent to which we can all continue to get excited, and we seem to daily, about opportunities in AI.
Yeah, I think that excitement daily that you just pointed out, Anna, is so crucial here, because if you look on the Bloomberg terminal about these analyst consensus, I am looking at 50 buys, 8 holds, and only 1 sell. Wall Street is extremely bullish on this stock when you look at the research.
Yeah, absolutely. And the pricing power that he was describing, quite incredible, going from selling GPUs to the gaming sector for $1,000, $3,000 up to $20,000, $30,000 when you're selling these for AI purposes. Just shows that it kind of depends who's buying it.
Yeah, the pricing is really interesting, and then you have to kind of factor in the inflationary story as well, and it turns into a very global story very quickly, which brings us, by the way, to news from around the world. Let's get to the first word here, and a lot to digest. Ukraine specifically rushing to evacuate people from flooded areas after that explosion at a major dam in the south of the country. The blast flooded villages, inundating thousands of buildings and threatening supplies of drinking water and electricity. Kyiv has blamed Russia. The Kremlin denies responsibility. In Canada, more than 100 wildfires continue to burn out of control. Thousands of people in Quebec have already fled their homes, and more evacuations are expected today. The effects are being felt as far as 500 miles away. According to Swiss air quality Q-Air, New York was the most polluted major city in the world Tuesday night, as smoke from the Canadian wildfires blanketed the city in haze. The global economy is set for a weak recovery, according to the OECD. The organization's latest economic outlook forecasts a 2.7% expansion of world output this year and 2.9% in 2024, both below the average in the 7 years before the pandemic. The OECD says the war in Ukraine, the shocks of COVID, persistent inflation, and the restrictive policies of major central banks are all weighing on the recovery. The caution follows a similar outlook from the World Bank. Elisa Mall, the chief investment officer for Michael Dell's family office, wants to diversify her portfolio. The firm is poised to absorb an influx of cash and stock worth more than $20 billion after Broadcom closes on its $61 billion purchase of VMware. The cloud computing company counts Dell as its largest shareholder. Mall says she'll use the proceeds to add more real estate to the portfolio and also expects to invest some in credit. Interesting, Anna, to start to see a little bit of this consolidation and where a lot of these really wealthy family offices are actually investing their money in a time when I would say regular investors are having a really hard time finding an entry point both in the stock market and the bond market.
Yeah, interesting that she's looking at credit, also looking at real assets. And we hear a lot about that being talked about here in Europe, whether it's infrastructure or beyond. So we'll continue to monitor that. Coming up on the programme, Gordon Shannon joins us of 24 Asset Management. He's going to talk to us about fixed income markets. We've spent a lot of time talking about how we might see a lot of issuance at the short end, in particular of the Treasury curve, and what's that going to do to trading around Treasuries. That's going to be in focus for us next. We'll talk to Gordon Shannon about that. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Downbeat data. China's falling exports stoke further concerns about the strength of global demand. Meanwhile, the OECD warns the world economy is set for a weak recovery this year. Citigroup CEO Jane Fraser visits Beijing this week, joining other Wall Street executives to travel to China despite growing geopolitical tensions with the United States. And the SEC doubles down on its crypto crackdown, taking aim at Coinbase a day after suing Binance. Coinbase says it's willing to take this legal fight to the Supreme Court. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a lot to digest in terms of headlines at the micro and the macro front, but I have to say at the top of the agenda, it does feel like those global growth concerns are really taking precedence.
Yeah, absolutely. A lot of the different names for that global growth concern, a non-recession. Recession is the way that somebody at Apollo put it over the last 24 hours. So a lot of people finding their own ways to describe what lies ahead for us. This is what European equity markets are doing with that kind of information. Not very much today. Sluggish trading across stocks, down by around 0.2%. One sector that's not sluggish, though, is the retail space. So selling clothes in particular in Europe seems to be doing pretty well today. So the retailers up by 2.5%. And the reason for that is the numbers out of Inditex. Inditex is the owner of the Zara brand. Their numbers described as stunning by one analyst. And it seems to be that the expansion of their bricks and mortar stores is persuading consumers to spend more money on each trip. And that seems to be working well for them, and certainly that was reflected in the latest earnings release from that business. This is the dollar on the rise, but against a falling Turkish lira, down by around 7% on the Turkish currency. Are we seeing the government coming to the end of a rather expensive intervention program in the Turkish currency with the arrival of a new finance minister, a Wall Street-friendly finance minister? That is the question that many in the markets are asking. Kriti?
Yeah, and I think sentiment that perhaps is flooding into the U.S. trading day as well. Anna, you described it as sluggish. I think it's the perfect word for futures action as well. They're virtually unchanged right now on the S&P 500, although we were down about 0.1%. So if you're really looking tick by tick, perhaps pairing those micro losses, 42.88 on those futures contracts for the S&P 500. I would argue more movement, though, in the bond market, especially when you look, again, tick by tick. On the front end of the curve, seeing a little bit of a sell-off, 449, really hitting against that 450 technical level, and that's really what you want to watch as we talk about what is getting priced in for the Federal Reserve in just a couple of days. Just how hawkish can they really be when you're starting to see these global growth concerns, and specifically services data in the U.S. coming back down about 2 days ago. We got those numbers. The dollar taking its cue from that story. What's interesting, though, is that if you were really worried about recession, really worried about a slowdown, wouldn't the greenback, in theory, at least see a bigger bid? And yet we are not seeing that at the moment, perhaps a function more of positioning, which brings me then to the commodity story, because that's really where you're going to see those growth concerns, specifically coming out of China. NYMEX crude trading at about a 71 handle, Anna, up about 0.2%.
Okay, let's talk about the global growth story and fixed income markets. Gordon Shannon joins us, 24 Asset Management Portfolio Manager. Gordon, very nice to have you with us this morning. Let me get your take on the global economy then, because I'm drawn to a few different bits of news around this. Various voices at Apollo calling this a non-recession recession or a recession light. I also saw that a Bloomberg survey of analysts puts a 65% chance on there being a recession in the next 12 months. How are you thinking about the path ahead and the possibility of recession?
So it's such an extremely well-heralded recession. As you say, a number of experts talking about it. If we look at various asset prices and the yield curve, which I pay particular attention to, the inversion of 2s, 10s has been waving the red flag for almost a year now. But yet we still haven't had, away from asset prices, away from surveys of outlooks, we haven't had the hard economic data. So I look, for instance, at the trend of credit rating agency upgrades to downgrades, and whether we look at Europe or the US or emerging markets, the ratio of upgrades to downgrades is still improving. So we'd expect to see more deterioration there. Unemployment, very low levels in the US, and it's barely shifted elsewhere.
Okay. So not necessarily seeing cracks that we might anticipate seeing, given how long we've been talking about the coming recession. Let me ask you about the supply in Treasuries markets then. Get back to the focus of your portfolio and Treasuries. There's been a lot said about supply coming in and a lot of supply expected at the short end. We now have some clarity over what it is that the Treasury is going to issue and when. Are they doing what you thought they would do? For some people, this was going to be a big wave of issuance, and then they saw the numbers and it wasn't as much as feared. What's your expectation?
Yeah, I mean, they have to rebuild the government coffers, the Treasury general account. I think what's interesting for me is the focus on bills. So almost all of that issuance is going to be sub 3 months. And that's mainly because that's where the demand is. They can attract money from money market funds. If they tried to issue longer than 3 months, given expectations about what the Fed might do, it's just not, it'd be difficult and they'd start to move the price. There's also a slight wonder about whether that's almost a directional play by the Treasury, that they expect rates to be coming down. It's going to be a serious issue for the US government as they refi their massive debt load at higher and higher rates now, higher for longer. That's going to eat up more and more of their revenue.
Gordon, for our international audience, though, connect the dots here. If you are seeing this kind of deluge of issuance at a time when you've seen credit markets really deal with this kind of eroding of liquidity, shouldn't that, in theory, if not perfectly, at least in some ways, kind of fix the problem of, in terms of things like bid-ask, for example? Why is that not a perfect match?
I think really, when, going back to this point about it being a well-heralded recession, but yet we're not seeing that in the underlying data. And you talked earlier about how well consumer discretionary stocks are doing. I think it shows that the system's still absolutely awash with liquidity. So despite the fact that we've had 500 basis points of rate hikes, there's still a lot of money out there, which suggests to me that whether it is a pause or a skip, there's still more QT to come.
Well, speaking of QT then, how are you looking at perhaps what's going on in the U.S. bond markets with then global bond markets? Let's factor in, say, the BOE, for example, taking a very different stance than the Federal Reserve. Are you then seeing international bond markets not necessarily in sync with each other? What are the dangers there?
Yeah, indeed. Last month was a fairly torrid month for gilts. While we didn't have any headlines at the level of government incompetence that we had in last September, we had similar levels being approached from gilts and a serious underperformance of gilts versus bonds or treasuries. Now, we can point to the inflation data that came in the last week of May in the UK, and core inflation was much higher than expectations and higher than the previous month. But actually, the bulk of the move had happened earlier in the month. And I think there it comes down to the rhetoric coming from the Bank of England. A number of the members talking about how they're still worried about inflation, how more needs to be done. And the last comment they made about quantitative tightening was that they may increase the pace of the active selling of gilts.
Going from the gilts market to other UK markets, so sterling credit, and thinking about sterling investment grade, you have a preference for sterling credit because of some technical factors. Yeah. What's the expectation?
So the one piece of good news there is that the Bank of England has finished its selling of corporate bonds. So that seller in the market has gone away, and there's a real dearth of supply from corporates into the UK sterling market, and we expect that to continue. Meanwhile, there's demand from pension schemes who are now in a position to de-risk, to seek to be bought out, and that increases their demand for sterling investment grade. So as long as we're careful about what the gilt market's doing and it doesn't force the schemes, the liability-driven investment schemes, to have to raise too much collateral, the technical's pretty good there.
We all talked a lot about those, I remember, back in the autumn of last year. So the technicals look pretty good as far as you're concerned. How does that leave the balance sheet at the Bank of England different to the other big balance sheets of central banks? I'm thinking of the ECB, for example.
Well, it leaves them with gilts, and they've got 800 billion of gilts. They're currently allowing that to reduce at 80 billion per year, 40 billion of active sales and around 40 billion of maturities. Perhaps they're going to increase that, but they're done with their corporates, whereas both the Federal Reserve and the ECB still have a huge amount of corporate holdings, and while they're letting those roll off, they haven't been actively selling them. So there's a lot of work there if they want to move those off their balance sheets.
Gordon, thanks so much. Thanks for joining us. Gordon Shannon of 24 Asset Management. We appreciate your time, and thanks for talking us through your thoughts on bond markets. Now, coming up next, we'll bring you our live interview with Ares Management CEO Michael Arougheti from the Super Return Conference, Private Markets in Focus over there in Berlin. Plus, our coverage of the Bloomberg Invest Conference kicks off later today in New York. Speakers include Stanley Druckenmiller, Henry Kravis, Dawn Fitzpatrick, and Nassim Nicholas Taleb. This is Bloomberg.
Certainly, the private equity boom of the last 10 years has been driven by a lot of firms that were not actually driving alpha, but we're really just taking advantage of levered beta. And free money allows you to do that. We're no longer in a free money environment and don't anticipate we will be for many years to come. And so our industry is going to have to go back to good old-fashioned creating value, creating value through operational improvement, buying well, finding good underloved companies and driving value that way.
That was the Apollo Global Management Co-President Scott Kleinman speaking to our colleague Danny Berger earlier at the Super Return International Conference in Berlin. A fascinating conversation there. I was taking copious notes. Danny joins us now for another really interesting interview with a leader in the private capital world. Danny?
Hi, Anna. Thank you so much. That's right. We have another fantastic interview, a giant in the private capital world. It is Michael Arougheti. He is, of course, the co-founder and CEO at Ares. Mike, thank you so much for joining.
It's great to be here.
There's been a lot of optimism around here, but of course the general environment is pretty difficult. Are we headed for the end of the golden age of private equity right now?
Interesting you phrase it that way. I'm not sure we were ever in the golden age of private equity, but things are definitely different in a couple of ways. One, the tone is clearly more optimistic than last year, despite the fact that it's still a tough market for PE. I think that's probably because people sense we're coming to the end of rate hikes. Buyers and sellers are going to be able to agree on value a little bit more easily, and I think there's optimism that the transaction machine and fundraising will pick up.
Well, you're a credit guy, so by your nature, you're maybe a little bit more on the pessimistic side. Yeah. Do you share that optimism?
I do, actually, and we're seeing that. We spend a lot of time, obviously, in the private markets where we can see the transaction pipeline build. And I would say looking out 6 months, we're seeing more deal flow already working its way into the system.
Okay, and so do we then have that break? Because right now at the moment it's buyers don't want to buy because it's too expensive and sellers don't want to sell at a lower level. What actually breaks that? What happens in the next 6 months that allows the flow to continue?
You need rate stability, because rate stability means price stability, and price stability at least means you can get a price and know what it's going to be. It may not be the price that you want, but at least you can start thinking about transacting.
Okay, so it's not necessarily the fact that we're at high levels of rates, it's just that they keep moving up, so you need that to stop.
It's the uncertainty. You need more certainty and more stability in the backdrop, and I think you need, therefore, the markets to calm down.
Yeah.
But I'm optimistic.
But I mean, not even the Fed knows really what's going to happen in this economy.
Well, they may know, but they don't know what's going to happen in the economy, but they know what they're going to do. They're just not telling us yet.
Yeah, okay, fair enough. So in terms of looking at deals then, if you're like, okay, in 6 months' time, things come back on the market, what will be the opportunities at that point?
Well, we think about the market opportunity in 3 different ways: public versus private. So much of last year, we were actually buying things in the public market because they were offering better value. Now they've shifted back to the private market. And then in the private market, it's primary versus secondary. And right now, most of what we're doing is what I would call secondary, meaning we're a liquidity provider to owners of assets and companies that can't access the equity markets. They're not selling, and therefore they need some kind of creative capital solution to help get to that new rate environment. Once we get to that new environment, the primary machine will turn back on, and then it'll be back to the regular way flow again.
Is there a sense that folks in this industry are having a liquidity issue as rates move higher and they need to plug the gap until we get stability?
100%. Even for the best companies. I mean, no one has seen 500 basis points of rate increases at this speed. And debt service coverage is a real issue. It's ironic because we're actually seeing some of the highest quality companies most liquidity constrained because they were the ones that were able to command the highest leverage. So it's an interesting set of conversations we're having versus prior cycles.
Do some things fall by the wayside then, where areas others don't step in to help? And what does that look like?
There's definitely going to be dispersion of outcomes, and there will be the haves and have-nots. Some who deserve it will get capital. It will be expensive. It will come with a lot of structure. But yeah, I think there will be some that will be left out, certainly.
What does it mean to be left out? Is that more consolidation in the industry? Is that some funds just die?
Yeah, I don't know, dying. I mean, because these are really, that's very somber.
Really dramatic.
It's very, here we were all optimistic, and you had to bring up debt.
The tone.
Yeah, I think consolidation is inevitable. We've already seen major consolidation in alternatives. We've seen it in traditional asset management, and now we're actually seeing traditional managers buy alternative managers, and I would expect that to continue. As a large manager, my own view is I think the large will get larger. We've seen in every cycle share consolidation, more capital flows to fewer people. And I think those that are really niche-y, really nimble, very product specific, they'll have a good go, but I do think there are going to be a lot of people in between that can't differentiate on approach or outcomes that may not be able to get to their next fund.
So then you do have this upswell of maybe some companies that don't get that support, other funds that, again, can't continue in this environment. What does that mean in terms of opportunities? Is there anything for you there?
Yeah, that's what we would consider to be the rescue capital, gap financing opportunity, and we're seeing that in real estate, infra, and corporates. I think that's going to be a big part of the deployment opportunity for the foreseeable future, really helping equity owners bridge to that new rate environment where they can monetize or at least access the equity capital markets again.
Mike, you also have a sports fund that you started. It's been a lot of sports news. There was the LIV Golf and PGA consolidation. To you, does this kind of show, hey, perhaps there's more deals to be done in this industry than we originally thought? There are more things on sale.
Yeah, it's funny. We launched our sports enterprise in earnest in the middle of COVID, thinking that we could be a real creative solution provider to teams, leagues, owners, networks. Everyone was trying to deal with the new reality of people not going to live events. We now know that the global demand for sports and unscripted content is growing at a faster pace now than it was pre-COVID. I think the LIV PGA DP merger is just another indication that there's a move towards global scale in a lot of these assets, and I think that's a good thing for everybody.
In terms of categories of sports, you of course have McLaren, you have the F1, there's been some chatter around football. Anything that you're particularly interested in right now that presents an opportunity?
No, it's been a real fun exercise for us. We're invested in Formula One, we've invested in MLB, we're invested in the NFL, F1, rugby in Australia, cricket in India. There's a whole host of global opportunity. Each league, each team, each country presents a unique set of opportunities and challenges. I think that's one of the reasons why we're uniquely positioned to do that kind of business.
Well, I hope you're a sports fan, because that's some fun due diligence.
I'll tell you, it's not very hard to get people to work on this fund internally.
I can imagine. Probably good for recruiting.
Yeah,
hey, Mike, that's all
absolutely.
We have time for.
Okay.
Thank you
Thanks.
so much
Great
for
to see you.
Really
Appreciate it.
And Anna, with that, I'll bring it back to you. That's Mike Getty. Varies.
Danny, thank you very much. Bloomberg's Danny Berger on the road for us at the Super Return Conference. We'll bring you more from that conference throughout the day and also tomorrow, including an interview with Joe Taylor, CEO of Ontario Teachers' Pension Plan. Up next on the programme, UK Prime Minister Rishi Sunak making his first official trip to Washington as Prime Minister. We'll get more on that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Well, it's official. Former Vice President Mike Pence has announced he's challenging his former boss, Donald Trump, for the 2024 Republican presidential nomination. Pence made the announcement in a video released today before a kickoff event in Iowa. Pence joins a crowded GOP roster with more than 10 candidates that is still growing. And Anna, of course, this comes on the back of former governor of New Jersey announcing his candidacy just yesterday. So very quickly moving story when it comes to the GOP.
Yeah, it's becoming a busier field, isn't it? Let's keep our focus on Washington. The UK Prime Minister Rishi Sunak begins his US visit today. He's heading to the capital, to Capitol Hill, in the afternoon. For more on Sunak's first official trip to Washington as Prime Minister, we're joined by Bloomberg's UK correspondent Lizzie Burden, who can give us a rundown of the agenda. What is on the agenda then, Lizzie?
Well, Anna, even though a transatlantic trade deal isn't even on the table anymore, Rishi Sunak is going to want to talk about the economic relationship between the US and the UK. He'll want to put it on the same footing as the security relationship between the two countries, especially when it comes to the Inflation Reduction Act. They're going to want to soften the edges, as the UK Energy Secretary Grant Shapps has put it, because Britain doesn't want to be caught in the middle between the Inflation Reduction Act on the one hand and the EU's
Chinese response to it on the other. But aside from the economics, they're also probably going to talk about Ukraine, very likely to reaffirm their joint support for President Zelensky. Also talk about China, how they can shore up supply chains and critical infrastructure. And finally, AI, really going to be prominent in this talks, especially after Rishi Sunak has said he wants a global watchdog for AI to be based in London.
Certainly a lot on the agenda for Sunak and Biden. Talk to us a little bit about the chemistry of the two leaders. We know Sunak has had a little bit of a bromance with his European peers. What's his dynamic with the president?
I wouldn't quite use the word bromance for this. There have obviously been moments when Joe Biden has actually forgotten Rishi Sunak's name. And remember, when it was the King's coronation, Joe Biden didn't attend. When he came for the 25th anniversary of the Good Friday Agreement, he actually spent more time in Ireland than in the UK. So the UK press has read a lot into this because, of course, Joe Biden's every move is very choreographed. So Rishi Sunak really is going to be trying to elevate the relationship. It is his first official visit to Washington. I've spoken to the former Prime Minister Tony Blair about the state of the special relationship. He says institutionally it's always going to be strong, but politically needs a bit of work.
Certainly something we're going to be keeping an eye on. A lot to digest between UK and US relations. Lizzie Burden all over that story. We thank you for the updates there. Let's get a quick look at some of the stocks we're watching in the pre-market. I'm going to kind of power through these. Coinbase should be top of your agenda after the SEC has officially filed a lawsuit there. Shares are actually higher by about 2.5%. Kathy Wood overnight saying, look, we still have faith in the company, so perhaps pushing those shares higher. Alongside it, another Kathy Wood favorite, Tesla, of course. TSLAs are ticker higher by about 1.8%. They're talking about pricing. They're talking about battery makers. And this is really important when it talks about tax credits. Tesla's new cars all now eligible for those. And of course, let's end with Stitch Fix here because their earnings came out, Anna. They are talking about exiting the UK, but they're getting rewarded in the stock market, higher by 7.6% off some cost efficiency plans in the US.
Okay, lots to talk about then when it comes to pre-market. We'll keep our eye on those movers. That is it for early edition. Surveillance is ahead. They'll be joined by eToro's Ben Laidler, BlackRock's Marilyn Watson, and NatWest Markets' Michelle Girard. This is Bloomberg.